Over here, we like energy. We like energy stocks. It's been our favorite sector for some time, but that doesn't mean we haven't experienced crazy waves. We have experienced crazy waves, and unfortunately, it resulted in me as a fund manager not taking home any fees last year after just a month before the end of the year having tremendous fees payable. Quite an unfortunate situation, but we live to fight another day, clearly, given our fabulous start to 2022 and path towards firm registration. That's pending financial advice. I am licensed to give that, okay? This is not a no financial advice channel anymore. Financial advice, okay? I'm licensed. Anyways, energy stocks presented a very peculiar opportunity. They were priced very cheaply versus where they should be and presented a tremendous buying opportunity. Similar to how in the early 2000s, after the 2000 bubble, Amazon was once a $6 stock. There was a mispricing. This is something that has happened throughout history in the stock market and will likely continue to happen throughout history. There are just massive declines, people taking money out of stocks, and herd mentality a certain way, and not a strong enough counter herd mentality, and a deviation away from the actual value of the company. We don't believe in completely perfectly efficient markets here. We believe there's some level of inefficiency, and we're clearly seeing that in energy right now with the massive run we've seen. And the unprecedented decline that we saw on Omicron. There was no real factoring of that, and clearly, we thought it wasn't a thing very quickly. Once we got that preliminary data, took some time for that to come off. So that whole efficient market thing, throw that out the window, and let's use it to our advantage. We've seen tremendous volatility in energy stocks, which has given us pain, given us buying opportunities, and brought us tremendous returns. There is an area of the market we've discussed that I am now beginning to feel is entering that territory in certain particular stocks. But I'm not ready to say, let's go all in and enter this area of the market. Before I reveal something that I have revealed in many other videos before, let's discuss strategy. It's a very uncertain time right now, and I don't feel super confident about the broad market. And because I don't feel super confident about the broad market, there's a lot of stocks that I don't know how they are gonna perform short term. Energy is an exception to that. It has shown us how it can perform regardless of how the market's doing. Yesterday the market was up, energy was up. Or last week the market was down and very scared, energy was up tremendously. So energy is its own fundamental story. Today we're getting low inventories. We know about the production situation. We know about the consumption dynamic. We know about the supply deficit. That area of the market has its own thing, and it can do well or poorly regardless of how the market's doing. Basically everything else has some broader market component to it. And it seems like right now one can make a very compelling case why the move that we're seeing the past couple of days, the NASDAQ leading, is a short squeeze. And I point to 10-year treasury yields. It's apparently a massively shorted play. That comes as no surprise. I am short the 20-year via an ETF, call options on an ETF. It seems like it's not a surprise to a large swath of the market that bond yields are low and they have to go up. For example, the last time inflation was at 7%, bond yields on the U.S. Treasury were 11.5%. They're 1.7% right now. So there's a massive potential catch-up move there, which is what our thesis was in energy. That led to a massive run to start the year. However, there's some areas of the market that also probably deserve some sort of catch-up play. For example, the 10x growth stocks. We're not talking about the great growth stocks that are tremendous companies. Things like Spotify, Shopify, Wix, etc. Those companies are great, but they are quite massive and relatively mature. I don't think a lot of people understand how hard it is to build a business that big and how far in the timeline of a business they are. They're pretty far down there. So to see them double from here, unlikely, because when they were double their current price, they obviously fell. And a lot of them have obviously fallen. However, there's a lot of companies that have also taken that 50% drawdown or more, because many of my favorite ones are way more than that. And they are very early in their timeline as a company. And they have a product or a technology that is going to be a massive product or technology. And even when they were at 100% of their 52-week high, for example, they were not even close to what the long-term valuation of that company can be. So when taking a breath and having a little bit more of a long-term time horizon, you can view them on a more linear, less volatile path. However, their current price before was well above that average path and is now currently well below that average path. It's not one of these companies that has had a tremendous run and is now deserving of going flat. It's a company that's deserving of continuing to go like this, but at one point was caught up too high and is now a little too low. I think those little too low stocks that aren't deserving to go flat because they are presenting tremendous future growth and tremendous current growth. They are doing stuff in the present. Those are the stocks that I think are presenting opportunities. And while we may not be at Amazon 130 to 6, we may not be at 6 yet, I feel like we're around 20 or 30 bucks. I feel like the amount of downside, there is some more washing out that can occur, okay? But these stocks are down for a year. There is some more that can go on. I'm not trying to call a bottom. Maybe we've hit the bottom, but I don't even feel good about saying that we have hit the bottom. That we hit the bottom on, Tuesday or yesterday or Monday or whatever it was when we were down 2.7% and then Monday and then recover the whole thing and ended up in the green on the NASDAQ. I don't want to say that's the bottom, even though we've had 2 back-to-back NASDAQ days since then. I don't feel good about that. And I have called bottoms before. If you go to my March 18th video, I called the coronavirus downturn bottom. I've had reasons to believe that. I don't have the same level of conviction now because of those companies I think should go flat and are very expensive. And a lot of people think might still go up, or at least they're priced for that, and they still got some air in those balloons. But these young companies, these novel companies, they're new, okay? They're volatile. That's characteristic of it. I'm happy to play them. Just give you a couple names I like, just to help paint the picture a little bit. Editas Medicine, I encourage you to listen to what they said today. They have not seemed to cancel any of their projections or any of their plans or any of their medicines. And for a company doing as complex stuff as genetic engineering, the fact that they have not stopped, halted, or canceled anything and have only seen positive results. Yes, there have been some side effects, but what medical treatment does not have side effects? The fact that they have seen effective results despite only being at a low or mid dose, not a high dose, aka high dose, hopefully we'll see even better results, is quite positive. And even if they are to hit hiccups in the future, I think you can assume that may occur. It may not, but I think you can assume it may occur and be happy to buy that company at just $1.7 billion compared to every other company valued like way more than that. I mean, obviously not every other company, but in the grand scheme of things, for the ability to edit genes, genetic engineering, okay? I think we're getting into that time that it's okay to buy these companies. Virgin Galactic. Did you think a couple years ago people would be able to go into space touristically? Well, they now can, and Richard Branson has done it, and the company's down like 75% since he did it. Okay, that is starting to look attractive. Smile Direct Club, braces suck. That stock is down tremendously. Tremendously. It has been affected by the pandemic. Makeup companies have been affected by the pandemic too. I assume once the pandemic is lifted and kids go to school, people go back out entirely, no masks, people are going to start caring about their teeth again. And that is something we can't do. You know, you get them in the embryo, your teeth are imperfect. Even if you've got genetic code for perfect teeth, there's a good chance you're not going to have perfect teeth. And that's a good business. It's going to be around for the foreseeable future. And braces suck. And it's an improvement in terms of the look and the cost on braces. Perfect product, if you ask me. And it's down tremendously and very attractively priced. I like that. 23andMe, another genetics-like company. It's great to have a good read on your biome, on your genetic biome, and that will certainly increase in importance as medicine improves. And that's kind of the next frontier post-pandemic that I see. And Kathy Wood sees. She says genomics, next revolution, genomics revolution. I've been on CRISPR Therapeutics since 2017. It was one of the first stocks I ever bought before I ever heard of Kathy Wood, actually. I like it. It's another one, CRISPR Therapeutics. You get the idea. These stocks are down. Smile Direct Club. Look at that chart. It's pretty freaking cheap. I'm starting to like these stocks. Not liking the mega cap techs. Not just Facebook, Amazon, Apple. I'm talking Spotify, Shopify, etc. Wayfair. I like these businesses. I think Wayfair I want to get into. But I want to get into Wayfair 50 to 75% lower than here. Okay? That's the deal. And that's today's video. Until next time, peace out.